Small and mid-cap fund categories have been topping the charts for some time now. And why won't they? When they have delivered fabulous returns and have grown investors' money by leaps and bounds. But not every fund in these categories is a win-win. Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of investing and personal finance. So for today's video, we have taken out the top 4 small cap funds that have performed consistently well over the long time period, as well as given you a decent downside protection. For new investors, let's begin quickly with understanding what small cap funds are and who should invest in them and who should stay away from them. Small cap funds invest in the companies that are ranked 251 and below in terms of their market capitalization. Now, market capitalization in easiest terms can be understood as the size of the company. So these funds have to necessarily invest at least 65% of their assets in small cap companies, while the remaining can be invested in large caps, mid caps, or debt instruments. Now understand this. As the small cap funds invest in small sized companies, you can expect a lot of volatility in their share prices. Small cap funds are like a wild roller coaster in the investing world, and they are not the best choice for beginners. So go for these funds only if you are a very aggressive investor and you understand the risks of investing in small companies. Also, you should have at least 7 years in hand if you want to invest in them. So mind your risk appetite before investing in them. Next, let's quickly understand how we took out the name. So let's take a look at the methodology. We tried to incorporate both the consistency of returns and volatility while taking out the best funds. So we started with looking at the 7-year rolling returns of all small cap funds in the last 10 years, that is from November 2014 to November 2024 period, rolled on a daily basis. There are 29 small cap schemes. Now, as we looked at the 7-year rolling returns, funds which have not completed at least 7 years of existence were automatically filtered out. So we were left with 14 funds. Now, for beginners, rolling returns is like calculating trailing returns, assuming you are investing on a daily basis. Or you can say it is like daily SIP for a certain interval and then taking an average of the series of returns. So as per the methodology used by us, if I say that the 7-year rolling return for fund A is 17.5%, it means that we took out the 7-year return for all the 7-year periods that existed in the 10-year time period between November 2014 and November 2024. So we got 2,464 instances of returns, means there were 2,464 7-year periods between the 10-year time frame considered. Now the average of all the returns obtained for these instances is the 7-year rolling return of fund A, which comes out to be 17.5%. So we filtered out the funds that had delivered higher than the category average returns. Next, to factor in the risk portion, we checked for the 7-year rolling standard deviation. Standard deviation measures how much a mutual fund's returns deviate from its average. For instance, if a mutual fund has standard deviation of 3% and an average return of 10%, the fund's return could be between 7% and 13%. So standard deviation measures volatility of the fund. Higher the standard deviation, the more volatile the fund would be. Coming to rolling standard deviation. So it works the same way as rolling returns. Just like we calculate daily returns for a certain time period in case of returns, here we calculate standard deviation on a daily basis for certain time period, and then the average of thousands of instances is termed as rolling standard deviation for that fund. Now we took out the schemes that have a 7-year rolling standard deviation of less than average 7-year rolling standard deviation of the category. This gave us the schemes that have been less volatile than other schemes in the category on an average. At last, we filtered out the schemes that have delivered 7-year rolling returns higher than the category average while being less volatile than the category. And this gave us the list of 5 small cap funds. But out of these schemes, we removed a tiny fund holding assets lower than 500 crore. And we got a final list of 4 small cap funds that can be considered to invest in 2025. We did not rank these funds. We are revealing the names as per their size. So let's start with the biggest fund. Nippon India Small Cap Fund, also the largest fund in the small cap space and of course one of the investors' favorite, manages assets worth 61,027 crore. Managed by the veteran fund manager Sameer Raj, it has delivered a 7-year rolling return of an amazing 22.09%. So had you invested 1 lakh in it 5 years ago, your money would have become almost 5 times, that is 4.9 lakh rupees by now. And a 10,000 rupees monthly SIP started 10 years ago, where you would have invested around 12 lakh rupees by now, would have grown to a massive corpus of 51.29 lakh rupees. Now, if you want to invest in any of these schemes or any other scheme, you can do that on the ET Money app by paying 0% commission for absolutely free. In fact, you can evaluate any fund of your choice on the app using an amazing surprise tool on the app. So do explore the ET Money app for mutual funds and other investment options. Okay, coming back. Next, we have SBI Small Cap Fund, the third largest fund in the small cap category. It has given a 7-year rolling return of fabulous 22.48%. Of course, the credit goes to one of the best fund managers in the country, R. Srinivasan. So if anyone had invested 1 lakh rupees in this fund 5 years ago, that money would have become 3.5 lakh by now. And a 10,000 rupees monthly SIP started 10 years ago, where you would have invested 12 lakh, would have grown to 41.61 lakh rupees. Then we have the fifth largest fund of the category with 7-year rolling returns of 19.72%, Axis Small Cap Fund. It is managing investors' money almost worth 24,000 crore. If anybody had invested 1 lakh in this fund 5 years ago, the money would have grown to 3.69 lakh, and an SIP of 10,000 rupees per month for 10 years would have made you 43.48 lakh rupees. That is more than 4 times. Do note, this fund has witnessed a change in its manager from Shreyash Devalkar to Tejas Sheth in May 2024. Then we have HSBC Small Cap Fund holding huge assets worth 16,919 crore. This fund has delivered 7-year rolling returns worth 18.73%. And if you had invested 1 lakh in this fund 5 years ago, your money would have more than quadrupled to 4.17 lakh rupees. And a 10,000 rupees monthly SIP started 10 years ago would have made you a gigantic corpus worth 44.97 lakh. And with this, we have come to the end of this video. We have taken out the best funds in other categories as well. You can find them all under the single playlist, Best Mutual Funds to Invest in 2025 on our page. And we'll be back with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.